Okay, well, hi everyone, and the Power Forecasting online event continues with a very insightful presentation from Hubert Penn, Chief Commercial Officer at Dexter Energy. He will share best practices for AI-driven trade optimization. Over to you, Hubert.
Yes, thanks a lot. So welcome everyone. This session is going to be about best practices that we see in the industry in regards to AI-driven trade optimization, and I'll try to provide to you a bit of a checklist on how to tackle these challenges. So again, my name is Hubert Penn. I'm one of the co-founders of Dexter Energy, and I'm heading the operational and commercial teams here at Dexter. And just before we go into the content, a bit more about Dexter, that you know where we come from. So Dexter was founded in 2016. We're based in Amsterdam. We have roughly 40 people that are basically working to build and improve our services. So we really focus on the short-term trading optimization in the power markets. We are active in the Netherlands, Belgium, Germany, Italy, and Romania. And we're basically increasing our geographical span this year all the way to Europe. And the services that are live today are generation forecasting for wind and solar. We also provide trade strategies, and we also help portfolio owners that have wind and solar in their portfolio to basically do asset steering. And also parties that have batteries, we help them to optimally charge and discharge these batteries. And our main customer base are basically companies that hold the imbalance price risk of renewable portfolios. So they can be generators, asset operators, or off-takers. And you might recognize some of our customers by the looks of these logos. So a few examples are Engie, Oxbow, EDF, or PZEM. So to structure my session a little bit, here's the agenda. So what I want to show you is what is happening in the markets and what impact it has in regards to balancing costs for renewable portfolio owners. I'll show some specific customer examples that we really see in the market where it hurts. And I'll provide to you some best practices that we see from our customer base, how they are approaching these problems. And I'll sign off with some takeaways, and I'll be happy to take some questions if there are any, and when there is time left. So on the challenges, I already mentioned to you the increasing balancing costs. So what we see is that the market dynamics really have been changing over the last years. Everyone knows that balancing costs are becoming an increasingly high problem, not only because of the renewables, but also because of the energy crisis of last year. So we've seen moments of illiquidity in the market driving further up prices. But also a thing that we saw is that there's been situations where there has been price data that has not been in historical data sets. So that's also increasingly hard to basically react to those situations. And to give you a bit of data here, what I'm showing you here is the balancing costs in 3 markets, Netherlands, Belgium, and Germany. And by balancing costs, what we mean here is the spread, the relative absolute spread between day-ahead prices and imbalance prices. And this is basically one of the 2 drivers that drives the definition of balancing costs for renewable portfolio owners. And what you're seeing here is that there's been a steady rise from 2016 to 2020 or 21 in terms of balancing costs as a result of the increase of more renewables in the market. And then on top of that came the energy crisis in 2022 that really steepened the curve in terms of balancing costs. And to give you a bit more detailed information to this here, I want to jump into a few examples. And for the sake of the shortage of this presentation, I'm focusing only on wind portfolios and wind examples here, just so you know. And basically the first problem I want to focus on is portfolio correlation with the market. So if you have a wind portfolio, you should understand what your correlation is with the market. And you should be aware that if you are using one or two of the most known forecast vendors, you might have a significant correlation with the market, and you should be aware that that's there. And to show you that in an example, so what you see here is the 5th of October in Belgium, and what you see in the morning is that there were really inflated imbalance prices as a result of a large shortage in the market, as seen in the lower plot. But what is not only important is the absolute height of the imbalance price, but also the spread between the day-ahead price and the imbalance price, which is actually the imbalance cost. And this, in this case, is roughly 900 euros per megawatt hour, which is a substantial amount. So what happened on that day? What you see is that there was expected to be an increase in wind generation. So the forecast here on country level is the red line, and what actually happened is the black line. So what you're seeing is that the actual production of wind was falling short, and in the lower plot you see that the absolute deviation was roughly 0.5 gigawatt. Now that was not the biggest problem, but in parallel to what happened here was that probably due to the lower ramping of the increased wind, there was also less irradiation, probably because the air didn't dry up as quickly as expected. And therefore here you see the same problem on the solar side. So the actual curve is way lower than the forecasted curve. And in absolute differences, there was about 2 gigawatts of shortages on the solar side, which results in 2.5 gigawatts of generation that you're missing in a market where regularly imbalances are not above or below 300 megawatts. Of course, a part of this was traded away in balance. So ultimately, so you can see this here. Ultimately, you didn't have 2.5 gigawatts of shortage, but only 1.2. But still, this was a substantial amount to drive up the spread between day-ahead and imbalance. So what did this mean for portfolio owners of wind and solar? So in this case, what I'm showing you here is the imbalance cost. So that is the imbalance volume times the deviation or the spread between imbalance price and day-ahead price of a customer of ours. And this here is the regular bandwidth here. And here you see this substantial spike as a result of this correlation. And what we're trying to point out here is the problem is the more renewables are coming into the grid, and this is probably going to increase again after the energy crisis, you will have these situations where there is asymptotical behavior. So if everyone is wrong at the same time, this basically will really give to you asymptotical price movements, which can be very dangerous from a trading management or portfolio management point of view. So the second problem I want to show you is special events. And what I mean by that is in wind portfolios, what can be tricky is icing and high wind shutdown, because it's pretty hard to predict if it actually happened and to what extent it will happen. And it's always, or usually, a binary thing. So either the assets are being curtailed or not. So it's really a binary thing. And what I'm pointing you out to here is also in the Belgian market on the 17th of December. Again, here in the afternoon and in the evening, we had shortages of 300 to 500 megawatts, but not spikes, but more substantially. And that also meant that the imbalance prices for several hours were very much inflated. And there was a big difference between the day-ahead price. And on the 18th of December, so a day later, that was even worse. So you can see here that the spread is actually more around 1,200 euros per megawatt hour, and even so in the evening as well. So there was more like a shortage of 700 megawatts. So what effect did this have on a portfolio level? This is what you're seeing here. So in the lower plot, you see again the imbalance costs from a wind portfolio. And on the top graph, you basically see the actuals in blue, and you see a forecast in green. And what you see here is that in general, they are overlapping quite well, but there is a moment here where they start deviating from each other. So in your mind, this is a sign convention that increased production is negative. So here you see the production is going up, and the general trend is correct, and also the timing is correct. So it's okay. But what you see here is that here actually icing stops start to occur, whereas the forecast predicts that the output will increase already. And the biggest delta is not here, but it's actually here. And what you see here is that it overlaps very well with the market. So what I mean here is you have a large deviation with your volume, but because you have the large price spreads that I pointed out in this graph here, you see that really the imbalance prices are spiking here. And I basically hit the lines here, but I'll show you in a second how large this spike was. And to summarize this slide is that it's important to start focusing on those few days where the imbalance prices are becoming asymptotical, so really high, and start managing that as good as possible. So what you see here is, again, a plot of the imbalance costs over a full year. And with the green line, I'm trying to show you that usually there's a lot of price spikes or imbalance cost spikes in the winter, so early of the year and end of the year, obviously because you are generating more wind, and with that also comes a higher imbalance cost. But this year, and by that I mean 2022, you see that there is high or expensive days all over the year as a result of generally inflated high imbalance costs. And that, of course, is driven by the high day-ahead price, and that again is driven by high gas prices. So especially here in the summer, you would expect that it would be a bit more calm in terms of imbalance costs, but in this case, this is not the way it goes anymore. And what we're trying to say here is that you're being exposed to the increase of imbalance prices, and what our suggestion here is to really start focusing to augment a volumetric position closing strategy with basically also taking price volatility and price movements into account when you trade your wind portfolio or your solar portfolio. So what are the best practices that we are seeing in the industry within our customer base? So on the generation forecasting side, we basically have a general best practice which is about the forecast correlation. And what we think is a good idea or a good strategy would be to diversify your generation forecast. So 5 years ago, what portfolio owners would say is that they would pick one external vendor and would have an internal solution, and that will be good enough. And but with the increase of the balancing costs, it's easily financially justifiable to have 2 to 4 forecasters in parallel, and the extra fee of 25 to 100K for an extra vendor usually easily pays back just by understanding at which this forecaster is good, and then basically to trade on that and reduce your imbalance costs further. And apart from having a positive return on investment, it's also good for business best practices, because you can benchmark your internal efforts a bit better and prioritize your research efforts, and at the same time you can leverage more knowledge towards the existing vendors. And then as a second approach, we would advise to also not conclude on a best accuracy portfolio level throughout 1 year, but start understanding that different forecasting vendors are better or worse in different setups. And an example would be there is, different performances to be seen in high, mid, or low wind situation, but also if you don't have historical data, the forecast might have a different performance quality than when you have a long time historical data. Another thing is really also start evaluating or give more attention to the special events I mentioned in the last slide, and also understand how those performances are evolving over time. And as a last tip, what we see is that most of the parties are using just 1 or 2 forecasting vendors that have been around for a long term, which is definitely reasonable because these are good performers. But at the same time, what we hear, especially in the Nordics, but also in other areas, is that many forecasters or many parties are nominating on the same forecast vendor. And what happens is that you're basically all trading on the same signal, and you will be even correlating more with the market. And on top of that is that you also will have price interference, so you're impacting the market. So when you evaluate in an offline mode imbalance costs between different vendors, you should take into account in which which forecast you used on which day. So really correct for that in the simulation what your market impact was in order to be benchmarking all those different solutions. The second problem I earlier mentioned was that there's a few days that have a really strong impact on balancing costs, like icing or high wind shutdown. And one of the approaches that we see occur more and more often to basically tackle those things would be to also use forecast ensembling. And that also, of course, mitigates the market impact. So what we advise here is start using different signals and start mixing them just to be less correlated on one signal. And to understand if there's value in this strategy or not, you can simply start with averaging 1 or 2 forecasts or even 3 or 4 forecasts. But you really want to go into a next step where you basically automate all of these forecast analytics parameters throughout different vendors. So basically start building a machine learning layer that basically does an automatic blending of different forecasters given a certain situation in terms of asset and or wind situation. The second point would be to start understanding how the performance is not only on one level, for example, asset level or portfolio level, but understanding it on both. And why we think this is important is because in general, asset level performance shows how fundamentally good your forecast is. But if you look at it from a portfolio view, you will have different vendors that will capture portfolio effects in a different way. And it really gives you an understanding on the strengths and the weaknesses of different forecasting vendors. We've actually invented a KPI to manage this. So what we do is that we measure our performance using the NMA, which is a similar metric as the MAPE, where we look at the basically the best performance in portfolio level. But we augment this by having a volume-weighted average NMA on asset level to understand what is happening on asset level, but then in a summary statistical way. And then so if you choose the best portfolio level forecast, this is the pragmatic approach. But if you also focus on asset level, it basically means that you have more analytical options. And then as a second step, what's also important is to know what your forecast actually entails. So what is it optimizing on and how does it handle trade-offs? Because there is a trade-off between improving on imbalance costs or on accuracy. And some examples is how do you handle icing or high wind shutdown or, for example, curtailment filtering. That really can impact one or the other, but you should know which forecast is treating which effect in which way. Then on the price mitigation side, we'd also like to share some best practices on trade optimization. And what we so what we say here is don't only do volumetric position closing, but really start augmenting your forecast using smart bidding. And what we mean by that is basically use a volume forecast and a price spread forecast to make a strategic bidding. So deviate from your volumetric optimal forecast to basically take into account that there might be bullish or bearish behavior in the market and that there might be a bias in the market, right? And that is basically a good way to address those price risks that I mentioned to you earlier. And also a tip would be to leverage your portfolio data to do this, because the inherent problem is that you have market correlation, but you can use this actually into your advantage to do so. The underlying best mathematical way that how we do this would be to use a probabilistic forecasting approach. So on both sides, on the generation forecast and on the price forecast side, we use a probabilistic approach, and then we combine this into an optimal bidding strategy. And then as a last tip, what we see as a winning strategy in what our customer base is using is they use different signals in this approach. So they have multiple external providers that provide signals, and they also have an internal signal. And basically, by doing so, you're diversifying your portfolio. So you have, from a risk management point of view, it's nice to have different winning signals that you're trading on. So you're not just betting on one signal, but at the same time, also your trading department get to learn about different strategies and can basically increase their knowledge about it. And another big tip that we have is start focusing ahead of time. So where we see that renewables portfolios have been doing position closing very close to the delivery. So just before intraday gate closure, we suggest to start working your way out in terms of ahead of time, and really start to have a good strategy on day ahead as well already, because you want to be ahead of the market when there is price inflation. So the key takeaways here are basically: one, try to diversify your generation forecasts. Really spread your signals a bit and start understanding the different signals and the different strengths and weaknesses to know what the possibilities are. Start optimizing and automating those different signals. So really try to mix, blend, and understand the differences and the strengths and bet on them or trade on them. And thirdly, don't only look at the volumetric risk, but really start understanding price risk and start to combine these into optimal bidding strategies. If you would like to receive the summarized list of these best practices I just went over with you, or if you would like to understand more how we can help you implement these best practices, we'd be happy to be in touch with you. So if you have questions or want to have a discussion on this in more detail, feel free to reach out to my colleague Philip or to me as well via email, or also via our website. There's a phone number as well. Thanks a lot for your attention. And I think there is a couple of minutes to address a question or two. So if you have any, please feel free to put them into the chat functionality. Thanks a lot. So I'm not seeing any questions yet. That's totally fine. So here we have, are the forecast errors correlated among the forecast providers? Yes, in some extent they are, because there is different weather models out there, but everyone knows that, for example, ECMWF is a very strong input. So of course there is some correlation, but there is also decorrelation. So really, if you look over a full year or over 2 years and you compare the different forecasts, you will see differences. And you want to basically take those differences as your advantage. Is a forecast error and imbalance an issue for solar output too? Yes, of course it is, definitely. So the underlying forecast line will look differently than wind, of course, and also the forecast, but the principle is very similar. How do you see these key takeaways apply to EV charging? Well, EV charging in that sense, how we look at it, so we do a project with a client here in the Netherlands where we apply smart charging. There, what you basically see is that you can use similar strategies there as well. So if you know what your load forecast is or your demand forecast, you can also strategically deviate from that. From a volumetric point of view, what we see is that there is a little bit less market correlation. So EV doesn't have the penetration on the volume side yet. So there is less risk, but there is definitely opportunity to basically take advantage of certain price directions. So what are some of the sources from which to diversify signals? So on the volumetric side, we would advise to have an internal forecast that is augmented with different forecasting vendors that provide forecasting to you. And on the price side, it's really about, do you want to build your own price forecast or do you want to purchase that? What's important is in the underlying part of price forecasting, there's always external data sources that you want to benchmark and check. And that is definitely something we could tell you a little bit more about, at least how we do it and where we see what is working and what is not. So AI methods for purchase price optimization. So just to answer this last question, basically what we use is machine learning technology for those different forecasts, both on the volumetric and on the price side. And I can also point you, if you want to know more, I can share a link with you in detail how we do this on the price forecasting side. My colleague and CPO of Dexter, called Tom Lemons, he just gave a deep dive presentation on how we do this and how we use machine learning for this problem. I'll be definitely happy to share this with you if you reach out to me after this session. Thanks a lot.